Thank you very much for attending today. My name is John Stenhouse. I'm the Business Support Manager at the University of Essex, and we are part of the University Enterprise Zone delivering investment readiness for businesses in Essex and beyond. So today I'm ably assisted by Josh Clark, who's going to handle all the technical aspects of this webinar. We have a presentation from Michael Berger, BDO. Now, Michael isn't available today, so we are actually using a pre-recording from an earlier webinar. However, we have the added bonus that we have today Adam Barron, who is the Assistant Director M&A at BDO, the accounting firm. And Adam is part of their growth advisory team, helping companies to prepare and raise third-party funding. So he is the man in the know. He works with the growth stage companies for a number of years and has very strong relationship with equity funders. So Adam, tell us about yourself.
Thanks, John. I think that you did me more justice than I can do myself, but thank you for the intro. As you said, I am part of the growth advisory team at BDO. We solely focus on helping companies to raise up to about, say, £15 million. The team was created about 3 years ago now to fill a gap BDO had in their offering in helping earlier stage companies. Our M&A teams have built really strong sector expertise. I think the greatest example is that the life science digital health team over the last few years has brought in a former cardiac surgeon, pharmacist and vet. So with that, obviously, came larger opportunities for them to work on. And although they wanted to work with younger and smaller companies, bandwidth constraints made it difficult. That also meant that the opportunities for the wider BDO firm to work with earlier stage companies were somewhat restricted. As most of you will know, the first thing an early stage company will want is funding. If you can't help them with funding, they will go elsewhere. So to be that first point of relationship for early stage companies, and also to help them to raise the money, BDO created our team. What BDO did slightly differently, and I think it was a great idea, although might be slightly biased, is they created a team of advisors as well as former investors. So one of the members of our team actually used to run Living Bridge's venture capital trust team, which is now Gresham House Ventures. So the approach that we take is that we take an investor lens onto all companies we talk to. We're quite pragmatic in that we will never just take on a client for the sake of a fee. I know that most people might say that, but being part of BDO, we're quite lucky that the relationship really drives what we do. So we'd rather have 6 happy clients a year and 20 happy relationships that we explain why we can't help them, but how other parts of the firm might be able to help them, then a wider unhappy client base. So hopefully that gives you a bit of an intro. Always happy to ask questions when my dog stops barking. But yeah, if you want to carry on with the presentation, thank you.
Thank you very much, Adam. Having difficulties finding my mouse there. So I'm now going to hand over to Josh, who's going to run Michael Berger's presentation. But remember, any questions, we will attempt to answer them, and that's what Adam's here for. So please, Josh, would you like to start running that presentation?
Okay, so let's move on and start going through. So this slide here is all about the funding landscape. Okay, it's from Q1 2020. We obviously have later information than this, but what it's really to state is that there's still a lot of money out there to invest into tech companies. There's lots of angel groups. There's lots of venture capitalists out there. They want to invest and they want to make a return. And ultimately, this slide is telling you that is available. Not only that this year, but because of the pandemic, there've been other schemes available to startup companies. There've been anything from bounce back loans, which you may or may which you should or should not have used. There've been C-bills, which in actual fact changed and allowed companies to use them if they were of a certain classification, so a negative balance sheet. There's also been the Future Fund, which is more for companies raising in their second round because they had to have raised an amount previously. but it's helping with innovation in this country, and it's all part of this early stage economy. As well as that, as I'm sure you're already aware, and no doubt I've already raised, there's Innovate UK and various other grants out there available, R&D tax credits for anything that you're creating that's related to research and development or innovation. And then, of course, the tax schemes for investors. So Seed Enterprise Investment Scheme, Enterprise Investment Scheme, and also VCT funds. Okay, so just on profiling, whilst this session will go through what are the key differences between angel and VC, there's more to it than what we're going to go through. I want to cover the summary, and then I want to go through ultimately what most investors look for, and that can relate to both venture capital and angel. So in terms of what you're looking for, an angel can be a supportive partner. They can also just be providing capital. So it's often said that people that don't have particularly interesting lives will then go and invest as an angel. I'm not sure how true that is, but there definitely are people out there that just have money. They want to invest via a tax scheme. In 3 years' time, they want to take their money back out, or in a longer cycle than that, and ultimately they will get tax benefits for doing so. So they recycle 100,000 or something like that, or it could be much more than that, but per investment, say 100,000. Venture capitalists can be similar, but they tend to they obviously have the capital. They tend to also try and differentiate themselves with some form of support, but don't be fooled, because they don't all support every business. Of course, those that are stars, they will support more. With regards to what support means, that can be everything. So it can be, an angel can just give you the money and say, you go ahead and work on your business. A VC can do that, and they can take things what are called observer rights to observe the board meetings. They can take a board seat if they really want to. Typically, not so much on a very early stage, but certainly once you're past a certain stage. And with doing so, with having that interaction with you, they can support you with the strategy of the business. They can support you with potentially advice around the operations, someone to call, someone to make introductions to their other portfolio businesses. They can introduce finance people that can help you with either an FD to help you run the business. They can introduce you to external support like that. The other introductions could be potential customers, potential suppliers, international aspects. So again, where an angel, you maybe wouldn't expect an angel to be on the international side, but most VCs would expect you to be trying to reach out internationally, and may already have contacted, if that's their specialist area, may have already contacted potential partners, affiliates to sell on your product. Sector knowledge is important, although it depends on what you want. If you just need the money and you're confident you can build the business, then sector knowledge isn't that important. Sector knowledge is important if you're missing something. So as some of you said before, some of you are in SaaS. Well, there's lots of different areas within SaaS, but it is good to have an investor that has invested into SaaS before. Not only will they know how to value the business, maybe that's a good thing, maybe it's not, if you're arguing for a better round, but they'll know about your area. They'll know about how a company scales in that area. They know about how much resource is required to get you to a certain level, how much you should be spending on marketing, how much you shouldn't, and any other questions you may have, they should be able to support. Acquisitions, not really for this stage, but when you get to the later stages, it often comes into anyone investing into a company, whether that's part of the strategy. Other areas to focus on, as I've said here, so you should always look at the angel themselves. What is their track record? Same with venture capital. What is the track record? So typically VCs do publish their returns. Angels, you might struggle with that, but you might want to get references from previous investments that they've made. From that, you can also ask what the sweet spot is. Similar to the sector knowledge, have they invested into your sector? If you're augmented reality, have they invested into an AR company before? Or have they invested into something similar that they can then add value to your company with that? In terms of fund cycle, that's really more about venture capital. You just want to know that they've got money available. So it can be the same for angels if they're recycling a small amount of money. So let's say they invest 200K via EIS. Well, normally what they do is 100K that cycles over 3 years and then they reinvest it. Not always, but that can be the case. So you just want to know at what point that money is going to be available to them, and they're not just trying to find out market information or information about rivals. Okay, so we'll move on to the next slide. So if you have both approaching you, it can happen. The VC world has definitely gone into various sizes of fundraise. So normally an average investment for an angel would be circa 25k. What you tend to find is that they syndicate the funds, so you end up with several angels coming together, one lead angel that effectively pulls that money together and invests it into a business. Whereas venture capital tend to start a little bit further ahead once you've demonstrated that you've got an MVP, a minimum viable product, and that you potentially have even signed up some contracts, or you're at a certain point in terms of revenue, whether that be recurring or in nature. So with angels, what's great about them is they can buy into an idea. What's not so great is that, of course, they will want their fair share of equity at that stage, and that might be good for you or not. There are other schemes out there that will that are mentioned on here. So often we see that very early stage businesses either go through a friends and family round, or they get a startup loan, for instance, 25k per director. They can also get, as soon as they start making revenue, a really new model that we're seeing a lot of is revenue-based debt, incredibly popular in the States at the moment. The UK is catching up somewhat. Things like Clearbank. So the angels, of course, go in, as I said, via tax schemes. So often that means that they're not involved in the company because it has implications on board seats. They also aren't always offering any kind of expertise, but it all depends on the person. I mean, if you get the ex head of Skype or the ex head of Salesforce or something like that, and you've got a business that relates to it, then fantastic. You're bringing in expertise into the business. With regards to venture capital here, you have to see huge scale up. This cannot just be an idea that's going to be a nice business and make a small amount of money, even if it's making 2, 3, 4 times the money. VC just will not invest. They want to be seeing a much higher return, which I think we'll go on to in a moment, but that'll be around the 10 to 100 times mark. We'll go on to the next slide. So again, in terms of levels, what we typically see is 25k to 2 million is the angel space. In between 1 and 2, there is that sort of crossover between the two, and then you go through the investment rounds. So each investor, in terms of venture capital, will focus on particular rounds. So they typically not into the friends and family round, but certainly on the pre-seed, seed, Series A, you have specific investors. You also have investors that look at life cycles. So they will go in at almost every stage and then stay with you following on the funding each time. That's just another example on the right there about the tax schemes and how they look to make a return over which period of time. Okay, valuation. So we'll spend a little bit of time on this, talking about the different approaches, because each market has their own rule of thumb for valuation. If you're valuing the shop at the end of the road, most people just say 3 to 5 times EBITDA, or net profit is effectively a proxy of EBITDA. And that's the rule of thumb. When it comes to an early stage business that has got massive scope to scale, to hit a market that is huge, and they're going to take a good percentage of it, that's got a great management team, that has high quality of earnings and a great product, of course, there's a different method to look at the valuations and how they look at their potential returns. So what you've got to think is, regardless of whether it's an angel or a VC, they look at their portfolio as a whole and they decide to invest in X number of companies, hoping that at least 1, 2, 3, 4 of the 10 or 20 that they invest into will make a large return, and the rest might do okay, or they might even be liquidated. They might not be successful at all. So the three legs of the stool that we look at are a psychology element, which is normally 5, 10, 20% of the business. There does seem to be an element of, well, we'd like that to be a number that we're comfortable with. The next area is, once you've built up your financial projections, all of which is around assumptions, depending on the stage of business you are. If you've not hit the market yet, if you're pre-revenue, then all of it's on assumptions. If you have started to sell and you've started to win contracts, then you have to make some adjusted assumptions, because of course, once you scale, you have other costs in the business, but you also have that potential for economies of scale. You also have that potential for a sales team to come in and to support further growth. So what you typically look at, depending on the type of business you are, say a SaaS business, it would be a multiple of your annual recurring revenue. That multiple will be based on the type of SaaS business you are. So if you are a, let's say that you offer cloud storage as a SaaS product, so you're paying on a monthly or yearly basis, you would look at other businesses within that sector. You would look at the multiples that they have achieved from previous transactions, and you would effectively be able to come up with an estimate for your business once you've adjusted that multiple for various elements, such as those I mentioned before: quality of earnings, management, and others. The stage of the business also has an implication on it. So you wouldn't expect to have a higher multiple than a mature, but not necessarily mature, but a growth stage business, because they've already proven it and they're continuing to grow, and therefore their multiple should be higher. However, you shouldn't expect it to be too low either if you already tick the boxes for everything else we're looking for with regards to a quality company. We see that they will always, of course, sensitize the figures, and there will always be terms within a document that allow them to cover themselves should they invest and it's not particularly great. We'll go on to those in more detail later on. Investor returns. So this is the key difference, I think. A VC will only look at a scalable business that can grow to it and make huge returns, 10 to 100 times, possibly even more. You know, the Ubers of this world. An angel, if you get the right angel, can look at businesses that maybe don't have those same aspirations. We find it rare that someone actually says that, but often some businesses can become lifestyle businesses. They can be a good investment, but not a fantastic investment. So angels will still back those ideas. And that's typically what we see the difference between an angel and a VC. The VCs go for businesses that have that huge potential, even if they don't work out. An angel tends to look at something and want to make sure that their money's fairly safe, depending on their risk matrix. I've noted here, what about discounted cash flows? What about convertible raises? So you've probably seen on various other platforms. So crowdfunding, for instance, I know one of the current crop of businesses has raised on Cedar/Crowdcube. They're one in the same at the moment, just successfully funded and is overfunded. They have raised on a valuation basis. What they could have done is they could have raised on a convertible basis, which means that they don't set a valuation today. They instead set a valuation in the near future. So maybe in 2-3 years' time. That means that whoever buys in today gets a discount on the business in the future. So if a share is worth £1 in the future, they will buy it for perhaps 80 pence. And therefore straight away they've made money on it, hopefully. With regards to discounted cash flows, we often see this with certain sectors, so fintech and other areas where you're effectively looking at how, again, it's based on assumptions. It's just another valuation method. There's lots of different valuation methods you can use. You're effectively looking at where the business is going, and you're applying all sorts of things, the terminal value to get an enterprise value. If someone wants more detail on a DCF, we rarely use them with the types of businesses that we work with, even though we work with a lot of tech. It's typically in more advanced areas where again, scalability is absolutely enormous, and a DCF is one of a range of valuation methods used. Onto building the equity story. So this is what affects the multiple. This is what affects the interest from the investors. So with regards to these areas, I'm going to skim through them fairly quickly. But again, if you have any questions related to your specific sector, we're going to stop in a moment and do a Q&A on it. So the market, you need to say how big the market is, and that doesn't mean if you are, a seller of AR equipment, for instance, saying that, well, everyone could use AR and therefore the market is the world. It's a case of drilling down on your specific market. What is your target market? You offer AR, for instance, for real estate, so people buying residential property, or maybe it's commercial property. And therefore you look at, okay, well, how many sales go through in commercial property? How many transactions is that? How many of those would you expect realistically to use AR? And that's your market. So it's then understanding the market drivers driver for that is, of course, the economy. What's happening in the property market, and then what is actually happening to that market at the moment. Is it growing? Is it declining? Are there competitors out there, and so on? Management, is there a clear leader, or is there a leadership team? How does the board look at this stage? If you're a seed stage company, we don't always expect there to be a full board. It's a bonus if there is, but ultimately those people typically need to be paid, and whether that's in equity or debt, equity or salary, sorry. Therefore, I would be cautious about bringing people on too early, but at the same time, what we see now is we see a lot of these decks that have pages of advisors saying that these are all advisors. It's often questionable how much involvement they have in the company. Operational team, of course, is key as well. Understanding that you've got the full team that you need, or that you've identified who you need to grow this business. Profit and cash, again, quality of earnings. How much do you need to raise? If your projections show that you're going to make X amount and it's like a hockey stick projection, why do you need to raise? Are you going to generate that much cash in the near future? You have to be realistic with your projections, and by being realistic, that's planning it out to say, well, if this amount of money that I raise now covers my costs to grow the business over this period of time, with a little bit of headroom in there, just again, have a look at it. Make sure you're not saying that next year you're going to make X million, because the chances of that happening without another raise tend to be quite low. And again, it's about having some realistic assumptions in there. Not to say that your top line won't grow, but the costs associated to that top line growing tend to be a lot higher than most people predict. With regards to the platform, we like to see, what is the tech deployed? Who has done it as well? Do you have that CTO involved in the company? Does the IP belong in the company, which is a must? What are the potential bolt-ons for the platform or the service or tech that you're providing, or otherwise, what's the service you're providing? Positioning, again, is looking at your other businesses that are in the market. Are you first to market? Often that's a great thing to be, but equally that means that it's an unproven market. So it's about identifying that. And different platforms enable you to do so. So if you can't just find it on Google, there's some great magazines and marketing firms out there that are offering free advice online or free articles. But if you can't, then ultimately you need an advisor to go and find from deal databases exactly what's going on with your competitors, and try and do some benchmarking to see not only in terms of all of these areas, in terms of where they're getting to in the market, who are their management, what's their profit, and so on. Typically not shown for an early stage company, but certainly if they've been invested into, you can often find out what the stake was, potentially what the valuation was, and that allows you to benchmark when you're negotiating with an investor. So this is just a summary with a nice picture of someone with a red coat. So we like red at BDO, as you can probably tell. Balancing the ambition with realism. So this is what I was leading on to before. Are you the next Uber? Most people think they are. That doesn't mean you aren't. It just means that most people think they are, and ultimately you have to back that up. So if you do think you are, make sure you've done enough work to demonstrate that that's the case, because people will question it, and as soon as you trip over on a question, it's not a great look. So how you can support that, you can effectively have the correct format for all of your financials, so a profit and loss, cash flow, balance sheet. You can show those monthly for 3-5 years. You can show your key performance indicators. So an example I often give is, if you're a gym chain, well, what are the key performance indicators within the gym chain? People joining, how many people, client retention, how many people are booking personal trainer sessions, what other key things, net promoter scores. That might be important for that type of business, because if people are demonstrating that they are happy and continue, they will continue to be retained as a client. Sensitize your projections, demonstrate the downside and the upside. Try and have a set of projections in the middle somewhere. Although any investor will always look at the downside as well as the upside, but focus more when they're pricing it on the downside. In terms of scrutiny, so all of the things started to mention before, going through from your new and existing customers, are you realistically going to achieve these sales? Depending on the stage of company you are, can you prove that? How do you prove it? If you're very early stage, let's say you're seed, have you signed any trials with potential clients? Have you got any feedback from those trials? Are they willing to convert that into a contract at some stage? And if so, can you get an MOU or an LOI, a letter of intent, or a memorandum of understanding from those potential clients? It's not excellent, it's not a contract, but it's a good start. With regards to I shouldn't say not a contract, but it's not a sales contract, I should say. So overheads, again, often we see overheads staying at relatively low amounts, and ultimately you do have to grow your overhead base as you grow a business. It's very, very rare. So it's all about benchmarking against larger competitors. So look at those that have grown, try and see what their growth in overhead is. And then you can apply it to your own, and then you can get realistic assumptions for where your profit margin is going to be over time. And I refer back to the SaaS business, the SaaS businesses and tech businesses that are joining this, if you have a business that's valued on revenue and you think that it's not important to control overheads, that isn't necessarily true. What you have to demonstrate is that this business generates margins, so whether that's a gross margin and a net margin, that correlate to the stage of business that they are. So yes, you can get a valuation right the way up to an IPO on your revenue, on your recurring revenue. But if it all doesn't match up and you actually are just spending so much, £1 doesn't equal £1.20 coming in, or £1 doesn't equal £3 coming in, and actually £1 is equaling 80 pence coming in. So every £1 you spend, 80 pence comes in. Well, that isn't a good business. So it's about maintaining those margins and demonstrating it and showing that if you stripped out that cost of growth, ultimately your quality of earnings are strong. I won't go through sensitivities again. You probably don't want to hear those. Customer insights. This is a really interesting area. So customer acquisition costs, lifetime values, are they relevant for a startup? Some would argue yes, some would argue no. I err on the latter. I think that you have to get to a certain stage to demonstrate that these are accurate. If you are just calculating them off the back of lots of different assumptions, very, very difficult unless you can stand on those assumptions and say that they're absolutely accurate. So again, if you've got any specific questions around them, happy to answer, but I'm not going to spend too much time on it. Business systems. This is through going through chartered accountants training that makes me bring this slide up. Not many people enjoy this, but it is so important and helps evaluation. If you can write down every system within a business, and ultimately your aim is to grow this business and potentially to exit at some point, having systems and processes, having KPIs in the business is absolutely key. It will maximize the valuation. It will maximize the impression that someone gets when they come into your business and perform due diligence, that everyone potentially is replaceable. Okay, certain individuals, it's more than a system and a process, but for the remaining people, that is important. So I would always have effectively almost a Bible-sized book that has your systems and processes for everything you do, and keep track of it. I know it takes time, but it's really worth evidencing. We will skip through some of these. So in terms of market size, we've already discussed the market size and what you should aim for, and actually don't say that your market is the world. It's not. Often it's a lot smaller than that. You need to be specific. So where your business is going to take over a particular section of the market, and whether it can build its own market. That's even a little more rare. There's always that question around whether the management can build that growth as well. Okay, we're almost at the next poll question. In terms of routes to the investors, which we'll cover off here. Most of you will know because you're already here. So you can join angel groups, you can join incubators, university-based ones and others. You can go to pitch events. There's loads of pitch events all over the country, now all online, of course, so it doesn't necessarily restrict you. But typically when you're looking for an angel, it's nicer to have a local angel, someone that gets you, someone that gets your business, someone you can phone up, someone that you can have a coffee with. Maybe not at the moment if you're in a tier 3 area, but certainly when it's normal. And equally when it's a venture capital firm, often, to be honest, in the UK, often it's, if you're in London, you're more likely to come across those people. When you're in other cities, Manchester and so on, you will come across them somewhat, but it's not quite as strong. Well, it's nowhere near as strong as London. Same if you go to Liverpool and then other cities, York, Birmingham, and so on. It's just the network isn't quite there. So what you have to do is you have to go to those events, you have to pitch, join networks like this that help you to get out there virtually, as well as physically when they're allowed to. Try and have warm introductions where possible. If you know founders that have gone through a raise, if you know advisors, a warm introduction is always better than a cold one. Cold ones don't always get responded to. It's to give you an example, VCs, some of them claim they see 3,000 companies a year. Some say 1,000. It's probably more realistic 1,000. Even advisors such as myself, we might see 200 to 300 a year, and we have to select of those 5 to 10 that we work with, because we believe that those are the ones that will raise the funding. In terms of pitching, try and get it right. It's not the easiest thing to do. Time limits, practice, video yourselves, work through it. Try and think of the questions that are going to come as well, because there's almost always a Q&A afterwards. And if there isn't, the angels normally get a chance, or the VCs normally get a chance to come and speak to you. Have your answers prepared, or at least know where that information is going to be. With regards to again, it being virtual makes the pitching process a lot easier, but also at the same time a little less personal. People can't just do those informal approaches. They have to message you or send you a connection on LinkedIn. It's not quite the same as just having that coffee afterwards at the side of the pitching event that you've just been performed, because that angel stayed behind to have a word with you. It's a little bit different. In terms of other areas to focus on, so being seen, awards, which incubators they offer a lot of publicity, free publicity. They'll run articles about you, magazines and so on, that like to pick up on who's been at what awards. Just be careful not to do too many awards and then lose sight of what you're actually building. We like to see the odd award, of course, it's nice, but if they don't have it, but their financials stack up, then that's absolutely fine. It's normally where it's a pre-revenue, or the revenue's maybe not grown quite as well, but the awards give you that sense that some judging panel somewhere that's got some expertise has looked at this business, they've looked at it in detail, and it almost gives it that sense check. And you hope that once you go through a due diligence that they'll see the same picture.
So certainly, Adam, it's a good point to pause. Couple of questions. Something that Michael mentioned but didn't elaborate on was, how do angels differ from crowdfunding? He mentioned seeders. We've been very successful in helping some of our entrepreneurs get seeders funding by going through our process. But how do angels actually differ from, say, seeders, crowdfunding?
So there are two main differences. One is that if you are getting individual angels, you're effectively choosing 6 or 7 people to invest in your company that can hopefully also strategically help you. So they are more than money or value add investors. When you are raising on a Seeders or a Crowdcube, or whichever platform you want to use, you can get hundreds, if you're lucky, maybe thousands of investors that invest £5–10 at a time into your company, and you're unlikely to know who has invested. So that, I guess that is maybe an advantage of angels or individual angels over using one of the platforms. But the platforms also do have their advantages. So if you are raising on one of the platforms and you raise from 1,000 people, that could potentially be 1,000 new customers for your business. And then you are also tapping into their wider networks as well. With these platforms as well, it does hit the press. So let's say you raise, or you get overfunded when you're looking to raise £2 million on a Seeders or a Crowdcube, that hits the press, you get more free publicity. So I guess if you're going onto one of those platforms, maybe look at it as a bit of free marketing rather than value add strategic investor. And if you're going to individual angels, you're looking for that more strategic help with the money.
Thank you. And there was something else which Michael mentioned as well. He was talking about convertible loans.
Yes.
And of course, we know now that the Future Fund actually closed at the end of January, last week, which was based on convertible loans. And we know that that's been very popular. So do you think convertible loans will still be an acceptable form of investing? And should investors actually look at that, and entrepreneurs too?
So personally, I think it's a really big gap in the market, and convertible loans, or the EIS version of it, which is an ASA, it's just become more prominent in both angel investors, but also companies' minds. I think that the tricky thing that most early stage companies have when they go to raising money is an argument about valuation. They put their blood, sweat and tears, it's their baby, into this company, and then an investor turns around and says, I'll give you 10 times revenue. So all my revenue is 100K. I've put more than £1 million worth of work into this. It's valued more than £1 million. So you have that disagreement on valuation. And what a convertible loan note does is effectively say, okay, let's delay the decision on valuation for another 18 months to 2 years. And 18 months to 2 years, hopefully you have built the business to be a company that's worth 5, 6, 7 million. And if you're doing that, then I will take equity in your business for a 20 or 25% discount on the round, whatever it is. But it just pushes that conversation down the road from a point which really does disadvantage the company if you try and value a company when it's pre-revenue or early stage revenue.
I mean, as a follow-on to the crowdfunding, which is relevant to both, if you get a high number of investors with small amounts, how is their return calculated?
So that is something that if you ask many VCs, they will say when they do see a company that's raised on a crowdfunding website, they are a bit cautious when speaking to the company or looking at their valuation. And that is because, as Mike said in his presentation, let's say you see a nice B2C company, you've eaten their product before, you've seen it before, you think it's quite interesting. You'll think, as an angel, that's really interesting, I'll invest in them. You don't look so much into valuation, you just look to want to be part of the journey. And as an angel or part of someone who's investing through a CrowdCube platform, you don't have anyone to answer to. I mean, maybe your partner or your children. You don't have investors that you need to turn around and explain why you've invested in that company, or when you do sell, the return that you got on it. But the issue for VCs is everything that they invest into, they need to look at what the potential return is, because they have their own investors that they need to report to. So even if they invest into something and it flies, and then at the end of the day, they get a 3 times return, but 3 or 4 of the companies in their portfolio have failed, it doesn't really matter to their investors that the one company they invested in has got a 3 or 4 times return, because their net profit and loss of investing into the company might be a return on investment of 5%, to which they'll turn around and say, giving you £30 million and I'm getting 5% over 3 years. It's not such a great return. So that is where the difference is. I think if you're raising through crowdfunding platforms, that's why you can probably achieve a slightly better valuation than you can through VCs. But then again, VCs do usually add a bit more strategic help. So they also want their share of equity for, what would you call it, a bit of sweat equity, but it's not really sweat equity, but for their money.
Yes, it's the added value you get by not going down crowdfunding.
Yeah.
I'm going to hand over to Josh to continue with the webinar. Thank you.
So what you typically get when you get to the point of an offer is a term sheet. It will go through, it will come through to you prior to any due diligence. Depending on the stage of company you are, that due diligence might be short, it might be long. It all depends on whether you're already selling, whether they need to go through any contracts, whether they need to go through the tech due diligence, or whether they just trust you. That can happen with angels. They can just put the money in and not perform too much DD. We have seen that. It often goes through how the deal is going to be structured, and it effectively, if it's a VC, it'll normally talk about their investment record and how they've gotten to where they are and why they're interested in your company. why they see this as the next sector to invest into. It does cover a couple of legal points in that, which are exclusivity and confidentiality, typically included in almost all of those agreements, or as a separate document. Shareholders agreements, which is often an area we get asked about. A lot of companies now do put them in place really early on, especially if it's multiple founders, just to make sure if one founder wants to leave, or if they do something wrong, if they go and set up elsewhere, that you are covered in those circumstances. Things like leaver provisions are covered. You might not go to the extent of things like key man cover. So if one of you, for instance, is the CTO building that platform, if you're a larger company and they were absolutely vital to it, then you might look at insurance policies to cover them should something happen to them. But ultimately, as a startup, you've got to consider your costs and where your risks lie. Okay, restrictive terms. We went into a bit more detail about these last time, and you can refer back to that video. But just to very briefly go over some clear ones that I think you should be aware of. So, when an investor, a VC, or an angel comes in, depending on how sophisticated they are, a VC typically is, angels vary completely, they will put some of these terms in, and it will depend on who they're being advised by or their own experience. Downside protection is normally a key one. So if they come in and effectively their shares are ranked above yours, what it means is should everything go wrong and you have to sell the business, they get their money out first, and normally they get that times X amount to come out. So if they invest £1 million, and when you sell, the business is worth 3 million, but they've put it in with some downside protection, they will get a multiple of it, and therefore maybe they get the first 2 million and you get either what's left, or you get a percentage of what's left, depending on the shareholding structure. Again, it goes into very, very specific details depending on the scenario, and that would be something to talk about if you've got a term sheet in front of you and you have to ask that specific question. So that covers things like liquidation multiples and also anti-dilution ratchets, which again is all around, which is probably happening quite a bit at the moment in certain industries, maybe not so much tech, although the odd ones are. If you raise at X level here, so perhaps you've done an equity crowdfund where the valuations at the moment are quite high, and then you go for a VC raise, which is actually on a down round because you valued it on a different basis when it went out to as a B2C via a crowdfunding campaign. The VC now views it and goes, well, in order for them to hit their return, they have to value it at X. An anti-dilution ratchet is meant to protect the original investors, so the angels in that case, from losing out on that down round. Tranched investments are also an interesting one, and something that can be used to your advantage or against it. What that would mean is, let's say, I think I've used an example here, 200k today, and they promise you 200k in a year. Now you have to just look at the terms as to how you get that 200k in a year. If you sell at the valuation today, do you not think that the 200k today will enable you to get to a higher valuation in a year, and therefore you should have a new formula for how that 200k comes in terms of equity? That's your most beneficial method of raising. So to know that, okay, let's say it's an ARR times X multiple, you agree that today, that in a year's time, if you grow your revenue, the company will be worth more and you sell less equity. That's one method. The other method for it is simply to say 200 today, 200 in a year, and it's based on the same valuation. That, of course, could go wrong for you. But if you do have a slump, potentially that money comes in, but often they've got a caveat to get out of it. In terms of these other areas here, leaver provisions and so on, this is all about making sure that if you commit fraud or gross misconduct, that effectively they could buy you out of the company, often for £1 or for a discounted amount, or based on market value, but market value without a CEO, for instance. Drag along and tag along rights. These are where effectively you can make a decision as a majority shareholder when to sell, when to raise money, and so on. It's about allowing minorities to either be dragged along with your decision, or if you make a decision that they can choose to come along on that transaction with you. So if you're selling, for instance, they can sell their minority as well. There's other areas of company law that link into that, and therefore you have to have those have certain provisions in there. Angels typically provide you with a simpler term sheet. VCs are more complex. There's no doubt about it. there's all sorts around redemptions and other areas that you may find in angel term sheets, for instance, whereas VCs will go into all of the above and more. Again, saved for a corporate lawyer because they can enjoy the legal aspects. We do get involved in that, but it's more for a specific legal webinar.
We will leave the webinar now because we don't want to get involved in those. And just whilst we're on the subject of legals, we do have a webinar coming up from Seed Legals, who specialise in legal documentation for seed businesses. So please watch out for that one. I think when we're looking at these kind of issues with businesses in general, we all have the same issues. Every single business that comes to us, the 200 odd businesses that have approached us in the last 7 months, have all had the same issue. They don't know how to get the right investor. And that's why we're running this webinar. Adam, would you like to add to that?
Yeah, sure. So, I mean, bar angels and crowdfunding and VCs, there are other things to consider as well. You can apply for grants, which are non-dilutive, and make sure that you're on top of your R&D tax credits, because I mean, if you are building something quite exciting, then you would have spent a lot of money, and as well, our R&D team like to say, it's your money, it's not the government, so ask for it back. But yeah, all these early stage conversations you should have. Like there is no time that's too early to start speaking to people about funding. If you are looking for a connection to certain funds, I know that I think it's Playfair Capital and Ascension Ventures. They offer quite good VC-based webinars, or I think it's called the debut sessions that Ascension Ventures are running, and Playfair Capital also have a female founder forum that they've put together. They're just two that are the front of my mind, but there are lots of VCs that I think the pandemic has made it a lot more accessible for people to get access to VCs, just to understand what they're looking for, because the more targeted your approaches can be to different VCs, the better. And that goes for angels as well. If you identify someone that you would like to invest in your business, I know that Mike used the example that might sound crazy to people of the XCO Skype or the XCO Salesforce. If you do have something that you think might be relevant to them, try and shape your proposition to them and explain to them why you think they might be value add to your company. And you've got to take the risk. You've got to go out there and explain it to them, and try and bring them on board if you think that's the best person or the best investor to be part of your company.
Very valid, very valid. And I think when we're discussing with entrepreneurs their pitch and their elevator speech, their summaries that they put onto the platform, investors are highly intelligent people. They don't need to be told how to suck eggs. But when they're looking at 20 or 30 opportunities on a platform, yours has got to stand out. So the message that you've got to give out initially has got to be very clear, very precise. And, you know, it's not just a case of, I want £300,000 and the minimum investment is 10,000. No, that's not the message that they want to hear. If they really like what you're doing, they'll read more, and they'll worry about the cost of reading more later. And this is something else you've got to remember, that, you know, you're asking angels to come on board for a journey, and you're probably going to go back to those very same angels and ask for more money later on, because they will probably want to stick with you for a long time. We know that in this kind of industry there is no norm as such, but you know, angels are often looking at 7 to 12 years to get a return on their investment. That's a long time. That's, you know, we're talking a decade. Well, we've just started a brand new decade. We're in 2021. So you think about it, an angel investing in your business is probably going to be with you in 2031 as well. And by then we'll all be buying electric cars, and, you know, the whole world will have changed. and COVID will be a thing of the past, and there'll be something else that we're worrying about. So, and we may have also rejoined Europe by then. So, you know, we won't go into the politics, but the world changes very, very quickly. So remember that when you're talking to angels.
Yeah, and I think that just to add to that, when you are presenting your deck to any form of investor, that they do, as you say, John, they do see a lot. So it's a style thing, but what I always think is best if you have an exec summary highlighting the strength of the management team, the market size and the opportunity. And every page needs to have something that wants the investor to flick to the next page. If you think you put something on a page that an investor's going to think, but aren't someone else doing it, or that's not really solving the problem, you need to answer that question on the same page, because if you don't, the investor won't turn the page. We speak to investors. I spoke to Mustard Seed a few weeks ago, and they're a team of 4 that see 4,000 opportunities a year. So if you want them to turn the pages in your deck, you need to make it engaging enough that they want to.
Yeah, it's all about time. Time is precious. We all value time so much. And, you know, Mr. Entrepreneur, you have put so much effort into your invention, your service, your SaaS, your B2B, your B2C, whatever it is, and you're passionate about it, but you've still got to get that message across. And that's where most people fail to get their investment, because they don't get the message right. That's why we're here to help you. That's why we have the Space to Grow program with investment readiness. We try and look at every aspect of what it is you're trying to do, and we try and help you along the way. I think we've run out of time now. I don't see any more Q&As. I'll just give it a few more seconds to see if anybody's got any pressing questions. But I think what we've learned today is that the help and support is out there. There's no such thing as a stupid question, just ask it. It's a lot to take on board. You can't know everything, but you can ask the right questions, and we're here to help you with that. And talking of which, I'm now going to ask Josh to ask the audience their opinions. So please, Josh, would you like to run the next poll?
Thanks, John. Okay, and yeah, so this one's another simple question. So do you plan to alter your fundraising strategy as a result of this webinar? Simple yes or no answer. And
please don't be shy. We don't expect people to be shy, because we expect people to be very upfront and honest in their approach to things.
Okay, thank you, everyone. So we'll leave that there, and I can see, is there another question in the chat there, John?
Yes. Adam, someone wants to contact you directly. Now, I'm not sure if this is a proposition or not, but are they allowed to contact you directly?
Of course. Yeah, the email address is just my full name, so that's adam.baron, and that's @bdo.co.uk. But I think that if you email Josh or John, they've both got my details if you want to pass them on if you didn't catch that.
We're more than happy to share the details, Adam, at BDO. And yes, and we are here to help and pass you through referrals, what have you, at any time. So as I said, please just ask. We're quite happy to do that. Adam, thank you very much indeed for helping us today. We look forward to working with you again in the future. Josh, thank you once again for timing of absolutely everything. And I think we're just on schedule, so thank you very much indeed. This was the University of Essex, University Enterprise Zone Investment Readiness Programme. Thank you and goodbye.
Thank you.